Welcome to Next Exit, where we speak to industry leaders about running and operating your business to maximize the next exit. Today we have Dan Bowyer, multi-time exited founder, angel investor, and founder and partner at leading seed fund SuperSeed.
The leading SuperSeed fund in the... Yes. Welcome. Thank you. Yeah, there you go. Let's go with that. Love to see you, Dan.
Great to see you, Dan. So first up, I'd like to hear about an introduction to you and your background. Obviously, you've got a prolific career in technology and entrepreneurship, but also a very interesting career before that, which we'd love to hear about too.
Well, I'm an accidental entrepreneur. I started off in media, left school and was modeling. So I did a whole bunch of teen modeling when I was like between 15 and 18, because when I was a kid, it was very trendy for young boys and girls. And then there was no iPads, there was no internet, it was all magazines and physical things that you pick up. So teenagers and tweens would buy big or smash hits or all these magazines of the day. So I was modeling in those, and I was great because I got to meet loads of pretty girls. I earned lots of money. I was still at school, so I was earning great money and traveling the world and having super fun in the holidays. Then I joined a band. I got an offer to be in a band. I've got no musical talent whatsoever. I was a boy band, a Simon Cowell's first ever boy band, which was an offer that I got after going for a pop video, and it became something else. And I won't bore you with the story, but if somebody offers you the opportunity, you say yes. So I said yes. I said, I can't sing or dance, but sure, let's go for it. So I spent a year learning how to sing and dance. I went to loads of acting, singing, dancing lessons. And then what do you do after that? So then I was a kids TV presenter for a couple of years, fell out of that. And because I was doing loads of kids TV, did a couple of years in the Broom Cupboard and CBeebies and CBBC and all those things that are still going, and was on Blue Peter and Newsround. I think Newsround might not be around anymore, but loads of staple kids TV shows, which is what an experience when you're like 19, 20 years old. However, what do you do once you've done that? And I left this world, and I would have liked to have carried on TV presenting, because I started to quite enjoy that, but it didn't happen for a number of reasons I won't bore you with. And then, what do you do? So always been good at fixing things, always been good at like electronics, engineering, a bit of computing kind of stuff. It was very early days. So effectively, after messing around, became an Apple engineer and a Microsoft engineer, installing networks and tin and servers and SATCOMs and stuff. And then realized in the mid to late 90s that this new software fangled thing is going to become a big thing. Built an accidental SaaS business, which is an IT services rollout, which is selling other people's hardware, software and services, and then giving customers a dashboard to be able to manage their infrastructure, and then selling that on a monthly basis. Not that I'd ever heard the phrase SaaS or understood what software as a service was. Then built then we built like a brand war room for advertising, so advertisers could see how their brands were performing across social media in the earliest days of social media.
What kind of social media platforms would that be?
Well, at the time, Facebook was obviously the big puppy. Facebook, Twitter. It was like 2008, 9. So what are we talking about then? It was the early days of all of there was still a lot of other niche platforms around at the time. What was that one where it was the location-based one? Some of our brands were, there were some lovely little niche things, and obviously some of the big behemoths that we still have around today. And then sold that to an advertising company, then did some work did the ticketing system for the Olympics, for the 2012 London Olympics, built a video interviewing platform, took over a publishing analytics platform that is still running, but it kind of is a bit of a zombie, but it still brings in money and, pays most of the bills. And then was angel investing, built an incubator, invested in about 55 startups in total over about 10 years. Then met my partner Mads at SuperSeed. Obviously, you know Mads well. And we, in 2018, were working with a mutual friend, working with a portfolio of companies, and said, well, why don't we do this? We've got some money and some time and hopefully some experience and some background in startups. And then wanted to build a venture firm, which was like the American model. So if you look at the Andreessens, and most of the big firms have a platform model, which is, we have a bunch of people that manage talent or can help with sales or commercializing. So why don't we build this kind of platform approach to venture capital? Started doing that in 18, 19 and run Fund 3 nearly. So There was a small fund, which was our money, then a 50, then an 80. And it's all around helping founders who are very technical, smart, doing very difficult things, help them commercialize and think about going to market and money and clients and product market fit and all of that stuff that you know in spades. So that's the checkered past, a very sketchy history in music and media. And here we are in venture capital doing crazy stuff.
Wow. Well, those TV shows, was that kind of early mid-90s?
It was.
I mean, I'd have been watching you after school and Saturday mornings and stuff.
I was going to say, I think you're about 10 years younger than me. So you might have been, it would have been me irritating you in the broom cupboard on the BBC, introducing the next rubbish cartoon.
Writing a letter into Live and Kicking or something. It's kind of.
There you go. Did Live and Kicking. What was the one before that? Whatever it was, Saturday Live and Kicking. Yeah, did all of those. Did loads of those, all of those.
Okay, awesome. And then, so you very quickly went through all the companies that you built from the first SaaS company through to the ticketing system. How many of those, how many was that? And how many exited?
So the four exited, but there's exits and there's exits, right? So none of them were kind of Zuckerberg exits. They were all enough money to give me a really nice lifestyle, enable me to invest some money. I'm not talking about 10, 20, 50K tickets. Meet some interesting people, travel the world, and have a really nice lifestyle. I have no interest in functional businesses. So I'm hyper excited by 0 to 0.5. As soon as a business becomes operational and is just more coins in, more coins out, my brain closes down and I have no interest. So that's why I invest early. So I love the early bits. But I didn't realize this till I sold my third business, and I realized that I become quite destructive when it gets to a certain functional point and clients are paying their bills and you're almost at product market fit and everything's working. I start becoming quite destructive in my own businesses. So that's not good. And this is quite symptomatic. I think many founders don't become good CEOs. It's quite hard to shift from founder to CEO because it takes a very different skill set. And I'm a pretty shocking CEO. So I'm an okay founder. I can do the nothing to some things, but as soon as it becomes functional and you need to get into CEO mode, and I think there's an argument for that for many businesses, I just can't make that. I don't want to make. You can. Maybe I could. I just don't want to make that transition. So there were two reasonable exits, two kind of squint and blur a bit, and you made a bit of money, and then a number of failures and a number of implosions and all the stuff that I think founders go through.
Yeah. Okay. So I guess talking about exits and preparing for an exit from a founder's perspective, of the exits that you had, did slowing down and being self-destructive once you got to the point of scale, did that hinder your exit?
Yeah, it did. And I was an unreasonable human, and I had no self-awareness as to why I was behaving how I was behaving, because however functional, however much money, however structured, humans are humans and people are people, and we have, our facts and our feelings, don't we? Now, if you look at a lot of the hyper successful founders that have made the transition to CEO and then they've had multiple exits and done extremely well, there's almost a coldness or a psychopathy or a detachment, I think. And I'm too emotional. So I think if you really want to make it venture backed and you really want to go the hard yards and you really want to have the meaningful, sizable exits, that's going to mean, there's this horrible trend now that, 996 and founder mode, and, you're not allowed a holiday, you're not allowed a family, you're not allowed to see your friends. But there's a lot of truth behind, as much as I don't like the argument, I don't like the discussion, there's a lot of truth behind, if you really want a meaningful exit and you are venture backed and you want a venture backable exit, which is speed of sales, speed of scale, that means you're going to have to knuckle down for the next 10 years. Because most people go, oh my God, you started the business and now you're an exited founder. That doesn't happen overnight. That takes many, many iterations, pivots, tweaks, whatever it might be. That takes, for most businesses, that takes decades. So we see these overnight successes. You've made lots of money. There's a lot of gray hair, misery, divorce, gambling habits, money problems. There's all kinds of stuff baked into that journey. And if you look at a lot of the successful people like Jensen Huang, he talks, did you see his talk? Was it a TED talk? I don't know where he was. He was talking about his work-life balance. It's like, well, yeah, I love work. I wake up, I think about work. 11 o'clock at night, I think about work. And he's got like 60 direct reports. that's the reality, is that is your life. And so there's many kinds of exits, and there's many kinds of businesses to be built, and venture capital does a very specific thing for a very tiny subset of the founder world. So I think you have to I think I'm starting to waffle a bit here, but you kind of have to know what you want, what exit you want, what kind of business you want to build. And then you can, make your plans and roll the dice as they fall, because whatever you plan probably won't happen. But if you want something meaningful, it's really, really freaking hard graft. And I, being completely frank, I just didn't have it in me. I hate admitting that, but it just wasn't in me to go those hard yards.
Right. So yeah, I think it was the Facebook co-founder, the Asana co-founder. Someone said, "What's it like having an overnight success at Facebook?" And he said, "Well, 6 years of coding all day and all night and not sleeping, it's actually pretty tiring." So
yes. Yes. And I think it's worse. I mean, for many founders that we speak to, the time and what you give up, I think for many, it's not healthy and it's not desirable. For some people, that's what they do and that's how they operate. And I'm kind of blanketing, and I know many people, and Mads, my business partner, is the same. And he's just on. We have conversations at 11 o'clock Sunday night. He's 24/7 on thinking about business, and that's how we roll. And many of our founders will speak to him, and I'll have many founder conversations at 10 o'clock on a Friday night, or so it is a mindset, and it's not for everyone, but it's a definite mindset. And if you want the big exits, that's where you go.
Yeah, absolutely. And so I guess that's a nice segue, moving away from being a founder and moving towards being an investor. What traits are you looking for when at the point you're investing? Obviously
in founders.
And what lessons have you learned from your own entrepreneurship that you're trying to invest in people that are similar to you and also dissimilar to you?
No, see, this is it. I don't want to invest in people like me. It is. I mean, I'm a VC, so people have to read up on the power law. They have to understand what venture capital is. They have to really know the beast before they get involved. There's friends and family, there's philanthropy, there's family offices, there's venture capital, there's corporate venture capital, there's grants, there's all kinds of funding paths for founders. And once you're on the venture track, once you're on the venture train, you can't get off. That's it. You've opened Pandora's box. So you have to know, when I meet founders, I'm asking them in multiple ways, what kind of business do you want to build? What is this doing in 10 years' time? What's your vision? How do you see this unfolding? Who's your ICP? What's the available market? Because I need 1 out of 30 or so companies that I invest in to go ballistic. That's what power law is. We expect maybe 2 out of the 30 to do meaningful returns. That's what having a portfolio is. The others of maybe 50% will do something, a 1x plus, and the remaining 50% will crash and burn. And that's okay, because we have this fear of failure in the UK and Europe, I think, which is, what's that famous phrase? It's like startups may die, but founders never do. It's okay. You pick yourself up, you dust yourself off and take a bit of a break and then get back on it, get on to the next thing. So I think Europe does that pretty badly. We hold on, we don't pivot, we don't make the hard yards, and there's not enough capital to just enable that fluidity to just keep going. There's a very strong argument that your first startup is your learning business. Your second or third might be the winner. But venture is a very, very specific beast. So when I'm meeting founders, they need to have this almost a cold psychopathy where they are obsessed with a thing. They're obsessed with a problem, and they can't sleep until that problem has been solved. You never know. And obviously there's loads of famous stories about startups running out of money. They don't run out of money. I think it's all bullshit. They run out of energy. They do lots of things wrong. There's a whole raft of things that happen either personally or commercially that enable the running out of money. But the running out of money is the last thing on the list. It's like saying, death was caused because I died. I mean, it doesn't make any sense. But that's how I see the world. Is are you willing to give up a life for a period of time, for a short period of time, to see if there is a venture scale opportunity here to go global, speed of sale, speed of scale stuff?
Yeah, absolutely. And you're on your third fund. You've been around for seven years ish.
Yeah.
You've had a few exits today from the SuperSeed portfolio.
Yeah.
Can you talk to any of those and the point of scale they got to, strategic or otherwise?
So we invested pre-seed and seed. Now those terms are pretty much meaningless these days. What is a pre-seed deal in the realm of AI when you have $50 million pre-product, pre-revenue deals going on? It's a little bit nuts at the moment. The industry is bifurcated between AI and everything else a little bit. And I'm very comfortable with the fact that within very short shrift, it won't be a thing because all companies will be an AI company.
Yeah.
So venture, just to give some context, venture works on a 10-year fund cycle. So we would like to see a return, a liquidity event within a 10-year fund cycle. So we'll invest for 4 years and we'll harvest for 6 years, or invest for 4, support for 2, harvest for 4, whatever it might be. It's those kinds of, that kind of split. So within a 10-year fund cycle, we would like to see ideally companies going the full yards all the way through the NASDAQ list, and off they go and make us 3,000-4,000x, whatever it might be. The reality is that most Series C plus companies fail, don't return capital. The reality is that venture capital, even though it's a very high performing asset class, it's held up on aggregate by the top 2, 3%, 4% of the industry, because it's very, very risky. And that's why we have power law. That's why it's always a portfolio approach. So the reason I'm saying this is that most companies, most companies will fail. Some will return something. We expect those outliers, those power law outliers, to go the full yards to rescue the whole fund. So the companies that, when I've had a number of personal exits, and we've had a number of exits in the last fund, even though it's very early. Excuse me. So we wouldn't expect to see anything meaningful for maybe 6-7 years. We invested in one of the exits in the November, and they exited the following January. So it was nearly a 14-month cycle, which is unheard of. So very early stage, not quite pre-revenue, but early revenue startup. We're going gangbusters. They're working in supply chain and logistics, and they sold out to an American software company. And the second was the same. It was a trade sale. We'd invested, that was about a 2-year deal. So very, very early. The reason that we had some exits and a number of venture capitalists experience either nothing or some almost, how would you frame it? Not rescue sales, but early sales, was because early COVID, when the world turned upside down, there was a strategy for some large organizations to then go out to the world and snap up and do some trade sales, do some preemptive purchasing for when the next bull run was going to go.
Yeah.
And there was zero interest rates. There was very free and easy money still at that point. This is 21, I think, just post COVID. So the world was very, very cheap to buy money. And venture capital was crazy, and there were funding. So there was this slight glut for about an 18-month period where founders were being made offers that they couldn't refuse. Now, we could block as the lead investor. We could, say, no, we're going to go the full yards, but no one wins. If a founder wants to sell out and they've been made an offer that they can't refuse. So that was 2 years ago, 3 years ago now, that was what happened with a couple of exits where there was that end of crazy ZERP time. Now what's happened is the opposite. Now it's, if you look at IPOs are dead. I mean, they're starting Trump and this new renewed, crypto crazy, frenzied nuts. I mean, if you look at the bond market, it's going this way, and you look at publics, it's going that way. And we obviously need public markets to do well because that creates liquidity, which then falls downstream, which enables more investment, which enables more exits. And the more exits there are at IPO, then obviously we can recycle. So we need that public markets engine. But so my exits, the last 2 were baked in crazy ZERPy times. So great, investors got money back, and who doesn't like getting money back? And they were reasonable exits. Everyone made lots of money. But that's not what venture capital is about. Venture capital is those and others in the portfolio going the full distance. I mean, for context, if we're investing in a portfolio company at investing 3-5 million quid, even 100 million is not even, that even that's not really what we're about. It's they're the levels of returns, the returns profiles that we're looking for. So it's tough. I mean, as you know, we've spent many a boardroom together working at how we're going to accelerate sales and get more money out of clients and where the next ICP is and go faster, go harder, because that's the VC model. It's really difficult. I don't think we're going to see, companies are staying private longer, as everyone knows. And I don't think in the short term that we're going to see, UK is dead for IPOs. So there's no recycling. It's embarrassing. I think got 5 IPOs this year, raising £78 million. 78 million, that's not billion, that's M. That's a M with a million. That's like a rounding error in the States. So they've got 17x more activity over there. It's like 1.3 trillion AUM or something. It's just nuts compared to the UK. But there are some green shoots in Europe. I think there have been 8 billion solid IPOs so far in 25. And 24, there were 3 of the biggest IPOs in the world were European last year. There was a cosmetics company, a skin therapeutics company, sorry. There was a PE company. What was the third? One was in Amsterdam, one was in Spain, one was in Switzerland. So it was but it's nice to see Europe. Everyone kind of decries Europe. It was nice to see a little bit of activity going on across Europe. And Europe's very attractive at the moment. There's a lot of cash coming into Europe because America is, how would you put it politely? A little bit risky. Who wouldn't invest in the States because it's nuts over there? 50 cents in the dollar is spent by American companies on software still. Yeah. So you can't ignore it, but the volatility is not serving them well. That's for sure.
Yeah. Has the reduced IPOs, reduced liquidity, etc., impacted the preferred business model of the companies as they scale from 1 to 100 million and beyond in revenues?
Yeah, it's a real problem. I think it's not. I don't think it's talked about enough. This recycling. Everyone knows the PayPal mafia or the Skype mafia or the Spotify. We all know anecdotally, but I don't think people fully appreciate beyond the founders that we know on the recycling tip. So when they get an exit, how they become investors and how they create that recycling in the ecosystem. But family offices, ultra high net worths, and other institutions, of course, there's lots of government institutional capital flowing across Europe. And so it should be. We need that recycling. We need public markets to then create those liquidity events for our financial stack to come all the way down to venture capital and then all the way down into startups. It's existential. And until we can unlock pension capital across Europe, which is happening across Europe, it's not in the UK yet, but hopefully with the Mansion House Compact, there'll be more pension capital unlocked. And I think Reeves, I don't know how the spending review today, wasn't there? I don't know what's happening in the next budget, but there's a lot of push to almost mandate pension companies investing in the UK in some way. Because 15 years ago, it was about 50% of UK pension funds have about half of their assets in the UK. Now it's about 5%.
Right.
So it's a massive cliff drop. And we've just talked about IPOs being, 80 mil. Who gives a monkeys compared to the billions across Europe and, billions and billions in the States? Until we get more investment and cash, recycling and getting out of publics and getting back into all the way down the cash stack, there's ventures at the bottom. Family offices, high net worths will maybe put 1 to 3% allocation into venture capital. We're the afterthought. VC's even that's the innovation, even that's where the magic happens, we're the afterthought. So we need more volume. We just need more investment. Without more money, we as a continent, and I'm putting the UK into Europe, we're screwed.
Yeah, absolutely. Yeah, that
was a bit of a bummer, wasn't it? Sorry.
No. I did all the actuarial exams and a few pensions papers, and I think if you spoke to my colleagues about more pension money needs to be invested in VC, they'd probably have a heart attack. But beyond that, have you got any horror stories or any particular traps to avoid for founders, CEOs, etc., running businesses?
Oh, there's so many. I think that the main challenge, the main explosions we've had across our private, Mads and my private investments and fund investments has been founder fallout. So I think first thing because I invested in the early stages. That's my play field is nothing to Series A and D. I'm in that early box, pre-seed, seed, whatever those things mean. So that's all I can talk to. So I think we've talked about the founder CEO transition, which is extremely hard, which takes a mindset shift. The other thing is just managing your energy as a founder, managing your energetic pot, managing all of the things that are going on outside of the business, your health, your booze intake, your family connectivity, your social connectivity. I know that we talked about psychopathy and not giving a monkeys about all these things and going for it and sleeping when you're dead and all those rubbish, pointless arguments that lots of people make. I don't believe in that. I think that's just not how humans are. So I think if there's anything that I would suggest to founders as they're getting off the blocks, you have all the energy when you start. So that first 18 months, 2 years is quite fueled just by adrenaline and crazy. But once you're in year 2, 3, 4, for me, it was always year 3, where it's like, the penny's starting to drop. The fatigue is starting to kick in. The frustration is starting to kick in. My irritation with other people is starting to kick in. That year 3 marker where you started to your business is in the flow. I think you have to manage your energy. You have to manage your diet. I mean, I gave up booze 6 years ago because I needed to focus on other things. So something had to give. I couldn't go out and have a skinful on a Friday night. I needed to. So everyone has their own version of this. I don't take holidays, but I'll take like breaks in the day. So I work 7 days a week, but I will make sure that I spend some time with the kids, then I'll block into work. Then I'll spend some time with my wife, and then I'll block into work. So everyone will have their own version of that, whether it's booze or time with friends and family, or time filling your cup, whatever that might be. I think those are key, and also making sure that you're getting the right people on the rocket ship. It's all about as your company goes from stage to stage, you get out of problem solution mode, you get into product market fit, you get into growth, you go into scale. And obviously you're transitioning through that from founder to CEO. You need to get the right people on the rocket ship. And they're different. The people, your team when you first start are not going to be the team when you get into growth mode, are not going to be the team when you get into scale mode. So being mindful of all of these things, getting advice, getting coaches, getting mentors, getting advisors, and time boxing them. They don't last forever. They'll maybe last 12 months. So they're the kinds of things that I'm very mindful of talking about founders with as they're going on their journey.
Okay. And looking forward, what are you expecting? Obviously, we're in pretty volatile times, politically, economically, public, private markets, etc. What are you expecting over the next 12 plus months regarding fundraising? If the market's split between AI and everything that's not AI, but everything's going to be an AI company anyway, how do you expect that to converge moving forward, etc.?
Yeah, there's two vectors here. One is the founder vector, and the other is the VC/LP vector. I think on the founder side, I mean, if you're not building an AI business, you will not survive. I think that's and it can't be, something plus AI. It has to be fairly fundamental to your model. So if you're not embedding that, I don't think you'll live. Fundamental, done. Cross.
Yeah.
Off the table. My personal take is that we will start to see stories where the application layer is starting to have real impact. And we've seen a few AI butting into the real world stories recently, with lawyers being told they'll be sanctioned if they keep citing ChatGPT hallucinations. We've seen, what was the other big AI story recently? There's another big AI in the real world. I can't remember what it was, but we'll see more of that AI into the real world at the application level. But the reality is that we haven't started in business. So all we've got is the news stories around ChatGPT or the Anthropic suite, or what Mark Zuckerberg's doing with Llama and the rest of it. We're only really talking about the data layer, the infrastructure layer, the tooling layer. We're not really talking about AI as it affects whatever it might be, law, health, education, manufacturing. It's only starting to layer in now. So I think we're going to start seeing much more of that, where AI meets the real world. We're going to start seeing, what was Peter Thiel's phrase, where bits meet pixels or something. I don't know. He's got some nonsense
atoms
phrase.
and bits or something, yeah.
Atoms and bits. Yeah, I can't stand the guy personally, but that's another personal emotional outburst. So we will start to see real application level AI starting to rubber hit the road. I think that's going to be really interesting and exciting. And then you can't dismiss quantum infusions. So fusion, they've got 20, 30 minutes of pure fusion now, which is massive. So I think energy is going to be solved in the next decade. So we'll have a world of abundant energy, 10, 15 years. I think that's closer than we think. Quantum will obviously kill blockchain, kill crypto, kill all kinds of encryption online. So there'll be a whole raft of solutions and problems cropping up from quantum becoming much more mainstream and usable. There'll be many more deep tech functions as AI unlocks more ability to do better physics, better chemistry, better life science, better bio, better pharma. I think that's really exciting and really interesting. And we're going to start to see this AI meeting the real world kind of factor. And that's where I'm investing. And that's what excites me the most. I think that's going to be exciting. And then fundraising around the fundamentals for startups, I think will be healthy.
Yeah.
Fundraising for anyone else, I think, is going to be problematic, but fundraising is always hard. And then with VC LP hat on, fundraising is always hard. I mean, we're top decile fund in Europe, and have been for best part of 12 months. And that's hopefully going to continue. But even fundraising for us is extremely difficult. Fundraising for the established firms is extremely difficult, unless you're a super brand name. And the industry bifurcated, right? You've got all these RIAs in the States who are now registered investment advisors. And they're not even VCs anymore. Sequoia, Lightspeed, Excel, and Andreessen are not VCs. They're RIAs, which is, I can invest in publics. I can take you from soup to nuts, Mr. and Mrs. Founder. I can invest in secondaries. I can do whatever the hell I want. So there's that crowd of the billion dollar funds. And then there's basically everyone else who are living in almost niche buckets. So that's how the industry bifurcated. So if you're in the non-tier one brand fund, it's going to be really hard to fundraise. But there's a lot of excitement for Europe. There's a lot of excitement for these new waves of AI hitting the road, and quantum and fusion and deep tech and other things. And there'll be some weird and wonderful consumer stuff coming up, like whatever Airbnb came up after the GFC. There'll be all these wonderful consumer toys that maybe came out of AI or some kind of silly B2B or some kind of other thing that become a really cute way of dating or traveling or transferring money or whatever it might be. There'll be some other consumer stuff that will obviously break through, because they always do. And so, yes, AI has kept the lights on, and I think there's more to do. So there'll be more fundraising opportunities for startups and venture capital, but it's going to shift. And there'll be many new venture models coming through, I think. I think there's still a space for a model that lives between angel and VC. So venture capital used to be called ad venture capital back in the days. And I'm going to try and reinvent the term for the gap that lives between angel and venture. So traditional venture up here. There's a lot of VC that isn't VC. They're incubators, they're accelerators, they're other, but so they call themselves VCs, but they're not. But I think there's another bucket. Maybe I'm going to call it adventure capital and try and own that, and then create a new funding model that lives for we're not unicorn hunting, but we're looking for like 5, 10, 50 million pound substantial businesses with some kind of circular business model. That'd be quite interesting. So I think we'll see some more venture-ish models that are going to come through. RIAs up top, trad VC, other, and then angel, super angel and stuff. I think there's a gap in that market. So yeah, I don't know if that answers your question, but I think it's a super interesting time, either as a founder raising or as a VC raising and going to market. Yeah,
absolutely. So going back to what you said about the application layer of AI and really butting heads with the actual real world, rather than, more just having the excitement of using it and it being magic, etc. Is there an argument whereby once it starts butting head with the real world and having more robust applications, can you then start tracking usage, ROI, pricing, etc.? Could that drag the valuations down?
We are in the world, and this is semi-controversial, and most people don't agree with me on this point. But if you look at how people are vibe coding and spinning up products on a weekend, there is an argument to say you need less capital to build. I think there's a fairly fundamental argument to say that most coding, I mean, whatever, 30 to 40% of Google and Anthropic and Facebook's code base is now automated. So with the toolkits that we have, with the frameworks that we've had for a while, with AI as the accelerant, to be able to 10x a really average or a newbie coder engineer to be able to do quite magical stuff, or even as a complete novice to be able to spin up products and spit them out and start businesses, I think that barrier is coming down on a daily, hourly basis. I was looking at the new Anthropic toolkits, the Sonnet and the, I forgot the other names. My brain is dying. Anyway, so they're so impressive. And the coding ability is just unbelievable. And its ability to reason and infer is unbelievable. So those toolkits are in the wild. I mean, forget DeepSeek and the other standalone super micro models. I mean, you've got a 4 gig model there that can absorb the internet and fly and make really, really strong, smart inferences. Like, this is nuts. This is utterly nuts. So the ability to spin up product and spin out and start up businesses and start up, I think that barrier is coming down and down and down and down. What will that mean for investing? I mean, sure, you're going to be able to go to market, but you still need money to go to market. You still need money to own a market, to become a potential category definer. You're going to need a lot of capital to do that when the time is right for you. So I think we'll see a lot more businesses, a lot more roll up, a lot more secondaries to start creating the liquidity on the other side. So I think there's going to be a lot more models. So I think it's going to, as everything in all industries, everything kind of, doesn't it? It kind of goes broad and then it goes deep and then it goes broad and it fragments and then it augments and it kind of, collateralizes again. So I think we're gonna see this breakout of all this incredible talent being able to go, I want to build a niche product that does this. That gets bought up by that PE firm or that startup, and there's going to be loads of these kind of aggregated models, almost like the bending spoons model. Go out and buy all your competitors. Go out and buy all the products or services that you want under your umbrella and you become a unicorn. So I think we're going to see more of that as AI enables more to do more quickly. What that means for valuations and fundraising, I don't think it's going to massively change. I think there's going to be always a market for a novel way of doing a thing. If there is a meaningful way of doing a thing, where there is a meaningful sized market, it will attract capital. So what that looks like and how we get there, I think is going to change massively, but the actual raise quantums and the valuations, I think that's going to be, I don't think that's going to move too much. I might be wrong, but I can't see how, okay, you might not be spending money on the bills, but you're sure going to be spending loads and loads of capital on the go-to-market. Possibly more, because competition might be even broader. Yeah,
absolutely. And looking forward, you're on SuperSeed Fund 3. What's the future for SuperSeed?
So, I mean, I want to build more funding models. This is not a popular conversation internally, but I want to build more funding models. I am super fizzed by the space that we've always been in. We've always been in AI. We've always been in deeper tech, even though, again, I get punched in the face for using that phrase. So we've always been in very smart, technical, B2B, difficult, solve, problem-y, businessy software. That's our world. But I want to go slightly broader on to different funding models. I'm going to build an accelerator. So I want to build like some kind of stipend. Come on, I'm going to give you $5,000 a month. Just play. Get out of corporate land or get out of that and do whatever you're doing. Just here's $5,000 a month. Just go and play. And then build that into some kind of incubation acceleration into then the pre-seed and the seed. So I'd like to own more of that early smart people doing smart things and then devise some new models on the other side. So the if this isn't a venture scale offering, there's an opportunity for you. There's an offering for you. There's capital for you. So we're hopefully going to close Fund 3 at the end of this year. So what are we now? We're in mid-June. So hopefully by the end of this year, we'll have Fund 3 in the bag. And then we'll see. I mean, more of the same to start with. So more technical people solving business problems where AI touches the real world. And then, agriculture, construction, manufacturing, supply, all these incredible things that need clever stuff. More of that. And then we'll see. It's just opportunity, right? Just a slight opportunist. We'll slightly jump where the jump needs to be jumped. I mean, we never made the whole blockchain silly, crazy bullshit. We never did that nonsense.
Yeah.
We've never chased the hype. But I think there's something really fundamentally transformative in how AI is going to transform business and our lives. And I want to be at the forefront of that.
Yeah, 100%. Well, this has been awesome. Thanks very much, Dan.
You're awesome.
I've got one more question, actually.
Go.
So you were Simon Cowell's first band.
Yes.
Is he in any of the SuperSeed funds, and is he on the cluster cap table?
Yeah, I haven't spoken to him in 20 years. We used to get together. We're both petrol heads. We used to get together and show off our new shiny toys. However, he's now in Bentley. I don't even know what's the Bentley Veyron or Bentley. I don't even know what the latest model is. I'm not in his league, so no. And also, I mean, he's in LA and he's got a face propped up by plastic, and he's hanging around with, Beyonce and other cool kids. I know I'm not in his phone book anymore. So
well, you get to hang out with me. So
there you go. Much better, much more wholesome, much more enjoyable.
Fantastic, awesome. Well, Dan Bowyer, thank you so much for this. This has been fantastic.
Always a pleasure.
Cool. Thank you very much.